Good morning and welcome to Stock Market Today. It is Thursday, October 25th, 2018, and I am your host, Dan Russo, the Chief Market Strategist at Chaikin Analytics. So we're going to dive right in. You know where I am on Twitter. You know that Chaikin Analytics sponsors PowerFeed TV today and every day. The S&P 500 took out key support levels, which we've been highlighting during a day of heavier than normal selling. Low of the day was 2651, very close to the level that marks a 10% correction from the highs. And in a bearish development, the 200-day moving average is beginning to roll over, which indicates that the long-term trend of the market is changing. In my opinion, a break of 2650 now would target the March lows around 2550 to 2580. To the upside, we're looking at resistance at 2700, which was former support, then 2740, and then at the 200-day moving average, which currently is around 2767. The RSI did leave a positive divergence on the chart as it failed to make a new low with price. However, breadth metrics have not diverged in such a way that would negate a retest to the downside. Now, in an encouraging development, as we get to the desk this morning, futures are pointing to a higher open. So we'll see how, really the key now is to see how the market reacts as it gets back to former support, now resistance levels. I think the first test is going to be around 2700. So let's look at the structure here of the S&P 500. And as we said, we are on the verge of a 10% correction. A 10% correction from the highs near 2940 would be roughly 2646 to 2650. So we kind of got down to that level yesterday and closed just off of the lows. So support, and it's important, is at 2650. Resistance comes into play, as I said, 2700, 2740, and then 2767 is your 200-day moving average, which is beginning to roll over. Now, the RSI is oversold, and yesterday's low did not make a lower low for the RSI. So you could argue that there is a positive divergence on the chart. And interestingly, Chaikin money flow remains bearish, but it too did not make a low that coincided with the low that it saw back on October 11th. So in the near term, the potential is there for a bounce, but really I think the onus is on the bulls to kind of start to take out these key resistance levels to negate the odds of a retest, but the downward sloping 200-day moving average does start to become a concern, at least in my mind. So jumping right into your market in a minute, what I'm talking about in my note today to Chaikin Analytics clients, as I said, S&P 500 breaks key support. That was at the kind of 2700 to 2720 zone, and now we're testing that key 2650 level. The VIX Term Structure is inverted. That signals fear, but also a potential short-term opportunity. The 200-day moving average is beginning to roll over, and breadth metrics, as I said, are confirming the weakness. Futures do point to a higher open this morning. And you can see now from a power bar perspective for the major indices, the deterioration. Dow is down over 2.75%, 3 bullish stocks, 3 bearish stocks here. So an even match where that had been predominantly positive over the last month or so. S&P 500, 33 bullish or very bullish stocks, 105 bearish or very bearish stocks, down over 3%. NASDAQ really caught the brunt of the selling as it just seemed like there was indiscriminate sales of growth and momentum stocks, 3 bulls to 19 bears. Small caps underperform the major market in a continuation of that trend. 93 bullish or very bullish stocks, 527 bearish or very bearish stocks. Obviously, in a flight to safety, the bonds caught a bid, as did bond proxies. Look at the utilities, up 2.26%. 15 bullish or very bullish stocks within Chaikin Analytics. No bearish stocks. According to the Chaikin Power Bar, small cap stocks and large cap stocks have become strongly bearish. Major indexes are mixed. Turning now, our stock of the day. In the email that you receive as a PowerFeed subscriber, we generate a stock idea for you based on our power gauge rating. And today's stock comes to us from that utilities group. It's telephone and data, ticker symbol TDS, closed at $30.67, down 7%. plus yesterday. But the power gauge rating is very bullish due to attractive financial metrics and positive expert activity. So what do we have here? A very bullish stock with a strong trend that's outperforming the market. The dynamic duo is in gear. The market and model are in agreement. So this is the type of name we kind of want to be looking at as a potential long idea, especially if we want to have equity exposure, but in a defensive manner. TDS is in that utilities group. Closer to oversold, on the verge of actually going oversold, but Chaikin money flow has remained bullish. 3 out of the last 4 quarters have produced positive earnings surprises. They are due to report on November 14th. Stock is above the rising long-term trend line. And just given that sell-off that we saw here yesterday, I think TDS looks compelling as an idea on the long side. If you want to wait for a little bit of a stronger oversold reading, just given the current market environment, I can't argue with that. But this certainly is the type of name within a strong sector of the market that we want to be considering on the long side of the portfolio. Take a look at TDS here today, $30.67. Turning now to our sector tracker. Looking at the movement over the last 5 days of the major S&P 500 sectors, and we could see the defensive nature of the market remains in place. Utilities, staples, and real estate, top 3 performing sectors, and the only 3 which are positive, speaks to the defensive rotation and defensive positioning that investors are adopting here. Energy down over nearly 9%, over 8.75% as oil has sold off. The industrials are being sold off on global growth concerns, as are the momentum names within communications. Healthcare and materials, middle of the road. We continue to be bearish on the materials group, especially given the weakness that we are seeing overseas. Our industry in focus today is one that had been a market darling, and now it's turned to the downside. Over the past 6 months, healthcare equipment subsector has outperformed the S&P 500 by nearly 5.75%. However, that power bar ratio, which measures future potential, is very weak, with more bearish than bullish stocks. It's currently ranked number 20 of 21 subsectors that we track, and it's moved down 12 slots over the past week, and you can see it here. No bullish or very bullish stocks, 16 bearish or very bearish stocks. And some of the indicative names there on the very bearish side of the coin are Rhythm Tech, IRTC, ViewRay, ticker VRAY, and Insulet, ticker symbol PODD. All 3 of these stocks have very bearish Chaikin power gauge ratings. Let's take a look at one of them here today. Insulet, ticker PODD, closed at 84.53 yesterday, down 5%. Very bearish stock, weak trend, weak industry group. So we know that this is the type of name that we want to consider selling from the portfolio or potentially looking at for opportunities on the bearish side. And we can see here that we've just recently begun to underperform the market. So to the downside, the market and the model are in agreement. The dynamic duo is in gear here as ticker PODD underperforms the SPY. What's interesting to me is that while we're trying to approach an overbought condition, we're not getting there. The overbought oversold indicator is actually rolling over before becoming overbought. And that kind of just gives you a sense of the weakness here in the stock, especially with Chaikin money flow registering some of the more intense readings that we've seen over the past 12 months. Stock is below the long-term trend line, which is beginning to turn lower. 3 out of the last 4 earnings announcements have been positive surprises for EPS. They are due to report on November 1st, so we are kind of inside of a week of that time frame. You're kind of testing the lower volatility band here. I think at the very least, you want to be cautious if you own this name. And if you're looking for an opportunity on the short side, I'd say maybe wait for a little bit of a bounce, just given where we are relative to the volatility channel. But this is certainly a name I would have on a bearish watch list. And if it's in the portfolio, I think, and you've had some profits, I think you need to think about booking some profits at ticker symbol PODD. Look at what's trending now. Yesterday's S&P 500 movers, gainers and losers. Varian up 7.75% on earnings. DTE up over 5% also on earnings. Juniper up nearly 4% on their earnings announcement. NI and PEG kind of benefiting from defensive rotation and positioning that we're seeing here. Both of those stocks up over 3% on the day. DXC down 16% after announcing a departure of an executive. RHI down over 10% following their earnings print. Semiconductors came under pressure yesterday following the earnings report from Texas Instruments the night before, and NVIDIA was not insulated from that, down nearly 10%. Alexion down nearly 10% on concerns about potential competition for one of their drugs, and Netflix is a very bearish stock, really has not been able to hold on to that post-earnings pop, continues to trade lower with the growth and momentum stocks. That stock down over 9% yesterday. Our earnings update, Tesla put up a really big print last night, and the stock is reacting positively to it here today. ServiceNow beat by 4 cents. That is a bearish stock. Northrop Grumman beats by $2.19. Defensive names have been doing well, and by that I mean the defense industry group. DTE Energy beats. As I said, that stock reacted positively, and Microsoft after the bell last night put up a good number. That stock was trading higher after hours and in the pre-market. And obviously, as we can see here, it's the Thursday of earnings season. Ton of important names reporting. We're going to hear from International Paper. We're going to hear from Hershey. We're going to hear from Celgene, Merck, and CME before the bell. On the bearish side, we heard from Twitter. That stock is trading higher. Love, Southwest Airlines, important name within the transportation group, is a bearish stock that's going to report before the bell. After the close tonight, all eyes are going to be on the tech bellwethers. Google and Intel and Amazon and Western Digital all reporting after the close tonight. As well in the healthcare space, Gilead and Cerner. Bearish stocks, Win, Mattel. We'll see how Mattel acts after Hasbro's print. Mohawk to get an indication of what that home builder supply chain looks like. Chaikin suggests caution when holding bearish stocks ahead of earnings. So as I said earlier, the VIX term structure is inverted, and this is just a sign of the fear that's in the market. This is the 3-month VIX versus the 1-month VIX, and normally the 3-month VIX is higher as uncertainty is more pronounced further into the future. But in times of fear, investors flee to protection, and the front-month VIX trades above the 3-month VIX, causing that inversion. This is actually a short-term positive. You can see that trips below the zero line have coincided with lows in the S&P 500 over the past couple of years, and the market is generally higher after a cross of the zero line. If you go out 3 weeks, the market's generally higher about 74% of the time for an average return of over 2.5%, or a median return of over 2.5%. So in the short term, the potential for a bounce does exist given this inverted term structure and the positive divergence on the RSI. But as I said, the burden of proof is squarely on the bulls at this stage of the game. Breadth metrics confirm the weakness. Here's the percentage of stocks trading below their 200-day moving average, and you can see that they made a lower low with price here relative to the October 11th levels. Really what we'd be looking for is retests that don't make a lower low for this metric to give us confidence that support is going to hold. Right now, that does not seem to be the case. And what we're seeing here, I think, is that the U.S. is reacting to global weakness. In the top panel here, we have the S&P 500, and you can see we're rolling over. But look at the ACWX, the ACWI ex-US Index Fund. That's been trending lower really since the beginning of the year, as have the emerging market stocks. So what I think is happening here, global market weakness is now bleeding into the U.S. markets. We bucked the trend for a while, but it seems to be catching up to us now. The global market weakness has been really the rationale behind my bearish view on materials, and we've often wondered how long the U.S. can buck the trend. So we'll see if we can get a stabilization globally and for the U.S. markets. But this is really, I think, a key driver of what we're seeing here in the U.S. So sign up for the email, chaikinanalytics.com/today for free stock ideas and to follow along with this show. We'll see you here tomorrow.